Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
Welcome to Sound Economies with Mel and Peter, an East Meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi, Peter. How have you been this week? I see that it's the summertime for you.
Yeah, it's a great week so far. Yeah, honestly, it's a bit in the countryside now, out of the office. Apologize for the summer cold. That happens now and then, but so the voice is a bit rusty. But anyway, it's a very nice time. Still, of course, open as always here in the shop, and we never leave the financial markets alone. So we are ready for this week's podcast as well. Yeah. What about you, Mel? How's life?
Well, I'm in the opposite side. So we are going through some rains here in Manila. But also still not leaving the markets alone. A lot to watch out for as far as every market is concerned. So it is a very interesting time. And we are discussing actually some of that in today's podcast. So just a quick roundup of what we have today. First, we're gonna explore a tale of two stock exchanges. So we're gonna look at listing activity or the lack thereof between Hong Kong and London stock exchanges. We're also gonna look at some companies that we'd like to focus on. And then over to China, there's this very interesting bit about an austerity measure that they're trying to promote that bans banquets as far as government employees are concerned. It's branded to be a public debt measure, but we'll look closely into that as well. And then, of course, over to the US, we'll look at the newest tariff threats from Trump and how the market is taking it in. And then we also ask what awaits investors after the summer holidays. And as usual, we will close with our global outlook. Peter, let's get started with our observations about the IPO markets in Hong Kong and London. We've had some discussion about that in past episodes as well.
Yeah, sure. Yeah, we have touched it several times, and also it's where we started out this year, discussing if it could be a bumper year as a really fantastic IPO year. The market went a bit sour after Trump sort of tried to hit the whole world and all these stories that we know all about. But anyway, there are interesting movements when we talk about the IPOs, and that's also why we touch it now and then. Now we've seen also, of course, the first statistics for the first half year
Mm-hmm.
showing that Hong Kong is actually in the lead of when we're talking volume of IPOs globally. And London, the London market is suffering its 30 years low. And that should, of course, just make us thinking a bit. Yeah. So what is going on? A couple of forces. No doubt, no doubt that the European area is slow, as the economy is slow. And after all, as we talk about, like every podcast, Asia is differently. Um, each and every country in the world has its challenge when it comes to growth and moving forward. But after all, there are areas where the growth is bigger. Now, why Hong Kong is performing so strongly as they are and they're shining, I see as a couple of reasons. First of all, that the US market is closed for a lot of Chinese IPOs. And that is the absolute preferred place to be IPO'd, that is on Wall Street. You would say it's the most prestigious, but it's also where the founders in China, they get a real asset moved out of China as they will continue to own a part of the company, but they're also listed in New York. That means they have assets outside China, and that is the biggest target for any wealth person in China, unless they simply want to stay domestic. So there's a lot of things why it is so fantastic to New York and get a listing there. But secondly, the U.S. market is for most companies also the most interesting to where an active, so being listed in New York is actually a very good way to access more interesting investors. And the pricing in New York is typically higher than the rest of the world.
Mhm.
So there's a lot of good reasons to be in New York. and that part is closed for many Chinese companies. And then you say, what is the second choice? And many have seen the second choice, and particularly many Western people, and particularly Europeans, have seen that, of course, that Europe is the second choice and not Hong Kong. But that is not necessarily the key. This is where we investors should be very observant. If some have followed the critical discussion about European stock exchanges the past 5 to 10 years and the European capital market, they will have learned that it is not attractive for companies to be listed in Europe, maybe unless they get a national listing, meaning a German company listed in Germany. But the capital market in Europe is not as attractive as in US by far, and neither in compared to Hong Kong. And this means that companies are simply avoiding listings in Europe. And this is also a reason why London is at such a year low. And we should remember that it's not only new listings that are missing. Some companies, they get delisted. So there's actually less companies to invest into. That is a risk for European investors. So there's a lot of components that are worth to watch here. And then, of course, why does Hong Kong shine as they do? Yeah, it ends up being the place to be listed for Chinese companies that might are already listed in Hong Kong or in China mainland. They want a secondary listing outside China, and then happens to be Hong Kong. Should that make investors being observant as well? Yes, it should be. And we have a fantastic example with Shine. How to describe them very fast? You would do it faster than I could, Mel. Uh,
Oh, Shein is an online shopping for
yeah,
clothes, but it's
exactly.
really cheap.
Yeah. So they have this very fast production model, Chinese origin, complicated ownership structures. They
Right.
claim to be based in Singapore and not in China.
Yes.
But anyway, the whole production, the whole whatever they do, as the internal production, so to say, and production lines, they're all in China, almost.
Mm-hmm.
But they do sell, they have big markets in outside China, is Europe and US and everything. And they're doing fantastic. They're doing good. Now they have tried to list in London for the past 18 months. It is sort of very close, but now it seems to swing back to be Hong Kong. And that is because the UK regulator and the Chinese regulator cannot agree on the description of the political risks that Shine is running because they have their production in Xinjiang in the region in China. That is a risk of abusing human rights from a European perspective, in particular. This political risk description, there's a disagreement. The Chinese regulator called CSRC, they don't approve the British or what we would call a European-like description of the political risk of being abused for maybe breaching human rights.
Mm-hmm.
And that means that a listing in Hong Kong wouldn't be a problem because the description of this political risk will be amended so it fits to the Chinese regulators' satisfaction. And there you could say, okay, that's proof that there is a difference if investors buy into a company that is listed in Hong Kong compared to if it's listed in Europe or in US. And we agree. As we agree, there is a what we would call a governance risk. It is different risk considerations that are surrounding Chinese companies that are solely listed in Hong Kong and China mainland. But we are talking about political risk. There's no disagreement about all economic risks in the company. This is about how we, the public, and
Mm-hmm.
regulators see differently on this political risk in China. So there is a difference, and it is also worth to learn from this process. But it is very interesting, and now it seems that they will move and probably do the IPO in Hong Kong. But it's also bit of explanation what is going on as to why is Hong Kong booming as it is. It
Mm-hmm.
is, after all, easier for Chinese companies to be listed there. And again, does it mean something? Yeah, there is a small governance risk that investors should observe and take into their consideration. And
Mm-hmm.
we do the same in our advisory. This is actually one of the reasons why Long Queen's Capital advise people to be underweighted Chinese stocks in the global stock portfolio.
Mm-hmm.
And again, let's take the next question. Why do we run a China fund,
Fun.
a successful China mutual fund, and advise people to say they should stay underweighted? Still, for many, many American and US investors, and European investors, if they just would do normal underweight, it would be an upgrade in their positions in Chinese stocks compared to today. So this is why we argue as we do. So we're a bit far away, doing different directions on this, what is a core IPO sort of story. But it is just so interesting because there's a lot of lessons to be learned, what is going on. Also in the capital markets in the different regions, reaching out to the different risk assessments of the listings. So we consider that extremely interesting and something that we learn, so we observe, and we think investors can learn a lot there on that one. Yeah, that was a long story, but anyway,
Very interesting though, Peter, because Shein has like exploded in the last few months. Like it's like a baby Amazon at first, but right now it has really made a name as far as if you're looking for a dress or something quick, something you can wear to a theme party or whatever, you do Shein. So, and that has been the trend quickly globally. So it's very interesting to track how the IPO will go, where it will proceed, and how soon. Because if they've been waiting 18 months and in Hong Kong they could do it in like weeks, it will be very, very fast. So that's something that we would like to um keep an eye out for because it is an exciting story, Peter.
yeah, it is, and of course it's one of after all it's a big IPO.
Yeah.
Yeah. So so interesting. What we consider as a summer will stay hot, I believe, in the market.
Right. Let me go to mainland China, Peter. So something interesting as well. Just a bit of a new policy that took effect in May. So it sounded a bit simple. The Chinese government is implementing what's really dubbed as a banquet ban for their civil servants. So that's about a few million of them. There are 8 million government employees and about 30 something million for state-owned institutions and enterprises. At face value, the initial rule is that large groups cannot dine out anymore. They cannot treat or pay for the meals or get treated to a meal by their business associates from the private sector. So sounds straightforward. It was initially branded as an austerity measure to keep public debt down. But on a deeper level, though, it does look like more of an discipline and integrity measure by, of course, the CCP and President Xi. But there are already some fears or like jitters that this could dampen activity in the hospitality and restaurant and catering sectors. So it is a bit cultural as well. So in East Asia or about a lot of Asian countries as well, it's like a culture where if you want to work with somebody or you want to impress a business partner, you treat them to a lavish meal, and then suddenly that's not an option anymore. So rather than risk getting reported that you did this, you like took a bowl of soup or a bowl of noodles from your from your business partners from the private sector, you'd rather not. So that's a seemingly small blow to consumption, to private consumption or to domestic consumption. But yeah, the fear or the scare towards breaking the rules in the mainland could be a lot different than what we usually would perceive. So it's something seemingly menial, but yeah, it is quite unique at the time when they're really hyping up spending, stimulus for domestic consumption and household consumption, and trying to stimulate more local activity at the time when, of course, they're still reeling from the effects of the tariffs, but not as much as they did a few months back, Peter.
Yeah, yeah. So it is a bit following the presidency thinking against bribing, and also showing sort of humbleness. It is also true now. It is solely concerning civil servants as a
Mhm.
public employee somehow. Yeah, but it is true that when Xi arrived in the office, as how was going on in Beijing when they had the big congresses, yeah, the
Mhm.
Communist Party and also the Economic Congress. The whole city was basically closed down. As a visitor in the city, you could be allowed to stay in the hotel. You could not go out on the street, and everything was closed down. So the party
Mhm.
members could, that's all the delegates could move around, and they were also all kind of hosted by all the trade unions, big unions, organizations.
Right.
Enormous banquets. Was simply unbelievable enormous. Yeah. And that was a bit clamped down, basically, by C. And now he's, or not he alone, but the party
Yes.
is hammering, even saying, okay, now you can max go out three persons.
Yeah.
Interesting signal. Will it hurt the hospitality business a bit more? Yeah, it will. So when we are talking, and that is part of what is in the statistics of private consumption, actually. There might be a small dip down there. Yeah, we could add that here in our company at Long Beach Capital, we have the strictest treatment policies you can find. We are not allowed to receive anything from counterparties. We are allowed to go out for a lunch. If a bottle of wine is offered, then it has to be a very modest one. It is written and it is actually handed into the Danish FSA that we are regulated by.
Right.
If we allowed to participate in economic conferences, but if there's some very fancy event afterwards, we are forced to go home. So this is a bit about how our life is. So it's just natural, yeah. So we can only support that these kind of measures also will be in the public sector.
Right.
Just to tell the story about how the big China and the humble language is behaving. Anyway, but interesting topic, Mel.
Well, on the idea of banquets, um, food, taco. So I don't know if it's crossed your feed or your timeline, Peter, but it's always a funny thing to read Taco describing Trump, where Taco is Trump always chickens out, and that's regarding his flip-flop on tariff threats and trade wars. And yeah, so over the past week, the July 9, that was yesterday, supposed deadline for negotiating the tariffs he imposed on everyone else, basically lapsed, but he went instead to postpone it again to the 1st of August. So the markets aren't really upset anymore. Like so far what we're seeing is that they're just brushing off that, oh yeah, he will always chicken out again. He's gonna move it back and move it back and move it further just so he looks
Yeah,
like he was trying to, be merciful towards the countries that he's imposing the hefty tariffs on. But in truth, there has been very little progress in negotiations. He said he'll do 200 negotiated deals by 3 months. That was yesterday. He
yeah,
has three signed. So that's really the crux of the matter as far as the US is concerned. By the day they're losing markets are losing the trust or the credibility that about these tariff proclamations. I mean, we've said that it did hit the US far worse more than anyone else. Their economy has contracted. China has managed to grow despite the 145% duty. It seems that stock markets all over are not as bothered anymore. So, whatever uh flip-flop Trump is doing has already been factored in, and the reaction has not been anything remarkable at this point. When the new deadline, if it is a deadline, was announced, and then we did just see Vietnam being the third economy to reach a deal with Trump, but it's unlikely that other major economies will do what they did. Like Vietnam basically conceded to remove tariffs on most US goods, and then they got 20% in return versus 46%. So, okay, that's a good deal, but we don't expect necessarily economies like Japan or India or the European Union to do the same.
The interesting story with Vietnam is, of course, that okay, US they get a 20% tariff,
Mm-hmm.
and you could say they can US companies can export to Vietnam, but the market is simply so small. It is not any big deal for US as such. Yeah, it doesn't move anything.
Yes,
It means a lot for Vietnam, of course it does. Yeah,
of course.
it's I fully understand why they rushed into to find a deal. Yeah. But for US, it simply means nothing, and that is sort of a key takeaway as well. The big blow, as you say,
Mm-hmm.
so far has not changed anything. It's not changed. What it has changed is it's hurting U.S. economy, it's hurting U.S. companies, and it's hurting the U.S. Stock market. And
Right.
more strategically, it probably leads investors to reconsider U.S. And this is still as after this, let's say, first half year and the
Mm-hmm.
deadlines you mentioned. It remains our conclusion. It's we don't see any change here in our standing on. He's just hurting the economy and
Mm-hmm.
nothing else. What about the other sort of Southeast Asian countries? Are they in a hurry or can they wait? Mel?
Well, I think Thailand is one of the Southeast Asian economies that's really trying to rush the negotiation. They were trying to finish it the same time, around the same time that Vietnam did, but they need the help more than anything because we know that the domestic Thai economy is suffering from a slowdown in consumption, a slowdown in tourism. High household debt is also keeping consumer spending down, and recently political concerns are also dampening investor sentiment towards the Thailand. So they are ready to like concede 90% of tariffs on US goods, so similar to what Vietnam did. It is a big concession as far as Thailand is concerned. It will make a bit of a difference for the local economy, but just the same, it won't really change anything as far as the US is concerned. They are more, of course, concerned about big partners like Europe and Canada, even Japan. But the news coming out of these countries is that they're not as excited or as keen anymore to negotiate or to give up more concessions, especially after Trump said something about forcing Japan to buy more rice from them. So it is a trickier situation, and if anything, the US will be worse off without these major partners.
And that is actually why we sort of discussed a bit, and we will touch the subject a couple of times probably when the U.S. and European summer holidays is spreading in the financial market as well. That's what is waiting for the market when people are back. Yeah.
Well, they are coming back to essentially a very uptight Trump, but who is trying to like bully his way against his major partners. Still trying to insist that it's unfair to run a deficit with them, so he'll try to bully them some more. But
Mm.
we see this early that markets are moving on from that drama, so to speak. They have seen, as far as the first quarter and maybe initial second quarter figures, that our economies aren't hurt that badly as much as the US is. So they will monitor what's or they will see how negotiations turn out maybe at the next couple of weeks or 2 months, but it won't really be a market mover as far as stocks are concerned. It's been priced in. If anything, domestic activity, inflation levels will be a bigger concern. And of course, individual company performance. We saw tech stocks rally overnight. So that's maybe more of the focus from here on, like the whole development of the semiconductor space, the tech and AI components and R&D. So it's the focus will be more industry specific rather than Trump rhetoric, Peter.
Exactly. Yes, there will be there will of course be a Trump rhetoric every day, but it's the market will be more immune. And
Mm-hmm.
as you mentioned, we expect sectors to be dominant, so people will really look out for which sectors are moving forward and which domestic economies are strong. Investors will look out for strengths, and the strengths will be part of where the domestic story is strong. So we're also looking for governments that can support the domestic growth. The global growth will be low,
Yes.
and it will be hard to find the good macro stories, but allow me macro stories, sorry. But as investors will return to market that is not necessarily complicated, but it is nothing comes easy. That is the market that will be sort of the second half year. And yeah, it's just as it is. And there'll be a discussion about rate cut or not in the US, but we go for
Mhm.
no more rate cuts right now. Yeah, no change. So this is what to navigate in.
I like summer that ends. We will see the sunshine prevail as far as the outlook for global markets are concerned, Peter. There has been, of course, continuing risks we see over the horizon, but there is still some strength that domestic economies can draw from going forward.
Sure. Again, as every week, we sort of do our sunshine wrap up if there's sunshine. Despite the discussion back and forth, where are we? Are we happy, Mel? Tell me.
We're still happy with what we see, Peter. Of course, we do keep an eye out for emerging risks and, of course, threats to global economic developments. But on balance, it is a pretty sunny outlook that we keep, Peter.
Yeah. And meaning we like still overweight
Mm-hmm.
equities. We like also the private market, the non-listed companies, particularly in Europe. We're happy about emerging market debt, particularly ASEAN debt, and we're happy to be sort of in the middle of the yield curve. Totally, we still prefer overweight of risk. And the thing we've talked about today, also what to expect when investors return from the summer holiday, we consider as just challenges to maneuver in, but the opportunities are there. We see the world is strong, and we actually consider private consumption, private households as carrying a lot of the next way forward. So yes, we continue to say most dominant is the sunshine. So that is excellent.
Right. So thanks, Peter, for sharing our views and our sunny outlook still on the global economy. Thank you to our listeners as well.
Yeah, thank you. Pleasure.
We'll be monitoring global developments and we'll share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Longines Investor Insights. Thanks for tuning in. For expert insights on the go, download the Longines Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top rated Mutual China Fund. To know more, visit longinescapital.com.